Julie Biel. She's portfolio manager at Kayne Rudnick and a CNBC contributor. Julie, it's great to see you. Overall, I mean, yeah, do we call this an earnings recession?
I think it's going to be pretty mixed. It really depends on the type of businesses you have. You can see some places in consumer discretionary doing well. You can even see some places in tech that are actually doing okay. Some of the software vendors that have really, strong, sticky, recurring revenue, they're going to be okay. But if you think about certain types of businesses, particularly in financials, and I'm not just talking about, you're smaller, but I think all the way up and down, it's going to be really challenging. And I think everyone is going to be taking a much deeper look at what's happening in terms of their credit quality.
Well, that reminds me of one of the areas you're looking for opportunity, which is basically kind of, correct me if I'm mistaken, providing tech solutions to the financials. Is that right?
Yeah, I would much rather own businesses that actually serve the banks. If I think of a company like a Jack Henry, it's a kind of sleepy software business that provides back office software to small and mid cap banks. You look at their financials through the Great Recession, it doesn't even look like they serve financials, right? That is the kind of durable franchise of earnings that we're looking for, because those tend to perform all the way through a cycle.
Or Verisk, I see here, if you're looking through the insurance space, you think that one as well?
Yeah, Verisk is kind of interesting, right? Because they have this core business that really has among the highest quality principles, right? People have to give them data and then they have to pay for the data back. That's a great business model. And they had diversified away from that. And now they're refocusing on the core business. And I think that's a real improvement in the financials for them.
Another thing I think is worth highlighting as everyone races to identify the next big platform winners in AI is that you're not racing to do that. Why not?
I think if you think about ChatGPT, right? I mean, my inbox is bombarded with expert calls on, what's the latest in ChatGPT. And frankly, we are just not able to predict this technology. We don't know. Did you really think that the first wave of AI was going to be in like making, new pictures and new art and new design? No, like you wouldn't really think that's what it was going to be. I think the healthcare applications are really interesting. But the thing is when you have this kind of nascent technology, you really want deep pockets and resources to exploit it. So a business like Google is probably better positioned than some fabulous whiz-bang startup. That's what we're focused on.
Yeah. What about healthcare, which a lot of people, they're kind of going to for this sleepy factor that you're describing. At the same, yes, it's had a good, 5 or 6 day stretch here, but the earnings are going to be down. The margins are going to be down. There's a lot of kind of post-COVID weirdness to work out still. What would you say about that?
Yeah, I think the thing about healthcare that makes it tricky is exactly as you say, the COVID weirdness makes it very hard to be able to guess how the businesses are really doing. I think for us, we're trying to avoid a lot of businesses that are sensitive to kind of FDA approvals and patents rolling off. It's kind of the same idea as what we're doing in financials. We like those businesses that are serving healthcare, ones that provide, the glass stoppers and tubes like a West Pharmaceuticals, where they benefit from a strong pipeline of drug development, but they're not dependent on the FDA for the individual approval. So there's less binary risk.
I guess broadly speaking, Julie, there's kind of two thoughts about the market so far this year. The Nasdaq's up 16% since Jan 1. And, half the room goes, see, there's no recession or it's already priced in and the stock market is telling you that. And in other words, you should chase this. And the other half of the room goes, this is a head fake and, stay to the sidelines and don't get sucked in. Which camp are you in?
I think it's one of those things where you're trying to be able to predict the complexity of the U.S. economy. And frankly, I can't even predict what my 5-year-old is going to want in his Easter eggs, right? I can't even get that right. And he's only slightly less complex than the U.S. economy. So I think if there's anything I've really learned in the last 2 or 3 years, right, is it's really hard to be able to predict these businesses and very hard to know how the economy is going to respond to exogenous shocks like major interest rate increases, for example. So I think for us, we really are trying to find these durable businesses because we know that they can perform well in good times and they tend to do better even when we are in a recessionary environment.
And does that leave you steering clear, for instance, of energy, of materials, of things that are highly geared to commodities, or is it, again, the picks and shovels approach?
Yeah, I think that's right. It's really hard to find businesses in energy in particular where it's a differentiated business and they're not super sensitive to commodity pricing and fluctuations. For us, earnings variability makes a business very hard to run. It makes the stock very hard to price. And so we'd like a more steady Eddie kind of business, and energy just makes it hard to find those.